Death of money as humans know it. Why AI agents will never have a credit card and what gets built instead. Everyone is arguing about whether AI will take your job. That is a wrong fight. The real shift is quieter, weirder, and already in motion. It is not about whether machines replace your labor. It is about whether machines replace your wallet, your credit card, your bank account. The entire financial apparatus that was built on the assumption that somewhere in every transaction there is a human being making a decision. What happens when that assumption is gone? Not in 20 years, not in a sci-fi scenario, right now, today. There are systems being designed where an AI agent is making 500 payments per minute, not per day, per minute. It is querying data sources, calling APIs, pulling content, settling in fractions of a cent. And here's the thing nobody wants to say out loud. It cannot do that on a credit card. Not because of regulation, not because of technology, limitations in any dramatic sense. Because of a fee, a 30-cent interchange floor that was designed for a world where the minimum transaction size was a human walking up to a checkout counter. That world is over, and the infrastructure that replaced it does not exist yet. It is being built right now, and whoever builds it first does not just win a market. They rewrite the rules of commerce for the next century. AI agents are making 500 payments per minute, and they cannot do it on a credit card. Not because of the future, because of a 30-cent fee that was designed for a world that no longer exists. When people think about digital payments, they picture convenience. Tap your phone, confirm your fingerprint, maybe Apple Pay or Revolut. Fast, smooth, human. You authorize, the transaction settles, life goes on. That mental model is exactly wrong for what is coming. Because the operative word in that picture is you. You authorize, you have a credit history, a dispute process, a cardholder agreement with someone who is legally responsible if something goes wrong. The entire architecture of payments for the last 60 years was built around one assumption: a human who can be found, verified, and held accountable. Strip that human out. Now you have an AI agent that needs to pay for an API call. It does not have a name, it does not have a billing address. It cannot pass 3DS verification because 3DS was designed to prevent fraud by a human pretending not to be another human. The agent is not pretending to be anything. It just needs to pay a tenth of a cent for one article and then do it again 499 times in a minute. That is not a payments problem. That is a civilization problem. Because we have built the entire next layer of the economy, AI agents operating autonomously, querying services, transacting on behalf of businesses and individuals and other agents on top of a financial substrate that cannot actually support them. Agentic payments is not a fintech feature, it's not a new app. It is a separate infrastructure layer. And I think most people building in this space are not being honest about what that actually means. Here's something that will bother you. HTTP 4.2, payment required. It is a status code in the original HTTP specification. It was designed into the fabric of the internet in 1991 and has been sitting there unused, marked, reserved for future use for 33 years. 33 years. The architects of the internet literally anticipated a world where machines would need to pay other machines to access content. They built a hook for it in the protocol. And then we spent 3 decades building ad-supported content, subscription models, and credit card rails. We walked right past the door that was already built for us. Why is that door opening now? 3 things happened simultaneously. First, the AI agents actually arrived, not as prototypes, not as demos, as production systems that are autonomous, persistent, and operating at a scale that make human-level transaction volumes look trivial. When a single agent can make more economic decisions in 1 hour than a mid-sized enterprise makes in a year, the payment infrastructure question stops being theoretical. Second, stablecoins became boring. That is actually a compliment. When something that used to be speculative becomes so unremarkable that developers build on it without a second thought, you have crossed the infrastructure threshold. Stablecoin settlements on networks like Solana and Base is now fast enough and cheap enough that sub-cent per call economics are mathematically possible for the first time. Third, and this is the one that does not get enough attention, publishers and data providers are bleeding out. The traditional content monetization model is collapsing under AI scraping. Google's overview feature already answers the question. The user never clicks, the publisher never gets paid. The data provider spent money training a model that is now worth nothing because the AI took the output and kept the input. These are not future problems. These companies are sitting in rooms right now trying to figure out how to charge a machine for the data it is consuming. That is the inflection point, not technology readiness, economic desperation. HTTP 4.2 has been sitting unused since 1991. The internet's architects built a door for machine-to-machine payments 33 years ago. We ignored it. AI just walked through it. There's a taxonomy being built to describe agentic payments. 3 categories: agent to service, agent to merchant, agent to agent. And in most of the conversations I have seen, they are presented as 3 parallel tracks, 3 versions of the same future. That is plain wrong. They are not parallel, they are a sequence, and the order matters enormously for where the money is going to go, who is going to build the winning infrastructure, and which of these 3 models is actually a Trojan horse. Start with agent to service, A2S. An AI agent pays the service directly, no human in the loop. API call, dataset query, article access. The agent pays in fractions of a cent using X402, the new implementation of HTTP 4.02, settled in stablecoin per call, not account, no subscription. This model is real today, not in 5 years. Today, Anthropic, Coinbase, and others have already shipped X402 implementations. The primitive exists. And this is where I want to challenge the standard take, because most people who are bullish on A2S are thinking about it as an API economy problem. Publishers selling access, data providers monetizing per query, that is all real. But the deeper thing that A2S does is something much more structural. A2S eliminates the subscription. Think about what a subscription actually is. It is a human workaround for the friction of per-use payment. You pay $20 a month for Spotify because nobody wants to authorize 0.003% or payment every time for song plays. The friction of the payment is more annoying than just prepaying for a block of access. The subscription model exists because micropayments were too expensive and too slow. If you fix the micropayment problem, the subscription model does not get disrupted. It gets rendered conceptually obsolete. Why would a publisher sell me a monthly subscription when it can charge the AI agent that is reading my articles on my behalf exactly what each article is worth? Nothing more. The SaaS industry was built on a billing quirk. That quirk is being fixed. Subscriptions exist because micropayments were too expensive. That problem is solved. The entire SaaS billing model is based on a workaround that no longer needs to exist. Now, agent to merchant, A2M. This is a model where an agent makes a commercial purchase on behalf of a human, books a flight, buys a SaaS license, orders inventory. The agent is spending real money at real merchant scale, with real consumer protection implications. And this is where I diverge from almost every take I have read on this. The mainstream argument is that A2M is just an extension of existing rails. Cards stay, SEPA stays, and you just need a better authorization layer above them. Delegated mandates, scope permissions, revocable credentials. The human grants the agent permission. The agent acts, the human remains liable. The argument is technically correct. It is also strategically naive. Here's the real question. Who controls the authorization layer? Because if the authorization layer is built by Visa, MasterCard, and the existing card network, then the human authorization model survives. It just gets a machine interface. The institutions of the 20th century payment system extend their reach into the agentic economy. Their revenue model remains intact, their regulatory relationships remain intact, their leverage remains intact. But if the authorization layer is built by a new stack, crypto-native, programmable, non-custodial, then you have just replaced the central coordination point of global commerce with something that is structurally incompatible with the existing control regime. That is not a technical question. It is a political and economic power question. And everyone in this space knows. Nobody is saying it out loud because the venture money and the enterprise deals and the regulatory relationships all sit on one side of that line. I'm saying it. The fight over A2M authorization is a fight over who controls the financial operating system of the agentic economy. And the existing players are not going to give that up without building their own version first. The fight over who builds the agentic payments authorization layer is a fight over who controls global commerce in the AI era. And the incumbents know it. Agent to agent, A to A. Two agents transact, no human on either side. One buys compute or training data or specialized inference from another. Machine-to-machine commerce with no human principle. This is a model everyone is most excited about in the abstract. It is also the one that breaks everything. Here is why. Every single legal and financial construct we have for transactions assumes a human somewhere in the chain. Fraud, a human deceived another human. Dispute resolution, a human with a grievance goes to a process designed for human grievances. Identity, a human is the ultimate anchor of any KYC chain. Reputation, a human actor has a history that can be investigated. Strip all of that. Now you have two agents transacting. One of them has been trained on compromised data and is executing a manipulated inference. One of them has drifted from its intended parameters and is making purchase its human operator did not sanction. Who is liable? What is the dispute process? Who investigates? We do not have answers. No real ones. Not institutional ones. What we have is three camps and they are pulling in completely different directions. The first camp is the crypto-native builders. They want machine-native identity, machine-native reputation, machine-native dispute resolution. On-chain attestations, verifiable credentials, programmable escrow. No human institutions in the middle. The primitives solve it. The second camp is a regulated finance world. They want A2A to route through licensed custodians. They want the human liability anchor to be mandatory, not optional. Every agent that can spend money has a legal entity behind it, a regulated account, an audit trail that certifies a compliance officer. The third camp is in the AI labs themselves, and this is the most interesting and least discussed camp. Because the AI labs are building the agents, they control the runtime, they set the parameters, they could, in theory, build a payments layer that is native to the agent architecture, invisible to the user, and deeply entangled with the model's behavior. Agent identity that is inseparable from model identity. Spend authorization that is baked into the inference pipeline. That is not a payment company. That is a central bank. And if one of the major AI labs decides that is the direction they are going, the question of A2A architecture stops being an open infrastructure question and becomes a closed ecosystem question. The AI labs building the agents could also build a payment layer native to those agents. That is not a fintech startup. That is a de facto central bank with no regulatory mandate. Maybe you are listening to this and thinking, this is not my problem. I do not build AI agents. I do not work in fintech. This is for a different audience. Here is what I want you to sit with. Every business that monetizes content, data, or services is sitting on top of a model that assumed a human would be a paying customer. A human who can be targeted with ads. A human who can be convinced to subscribe. A human who comes back because of loyalty, habit, or brand affinity. Agents do not have brand loyalty. They do not have habits. they optimize. If an agent is querying your data, it is going to find the cheapest compliant source. If your competitor drops their X402 price by half, the agent routes to them instantly, automatically with no friction. The businesses that survive the agentic economy are the ones that price correctly for machine consumption, not human consumption. Those are different pricing problems, different optimization functions, different competitive dynamics. And the business that do not adapt, they will be scraped for free until the data is exhausted and then abandoned. That is already happening. The A2S layer that gets built does not help them if they are not in it. Being outside of the agentic payment infrastructure is not a neutral position. It is a slow liquidation. Here's a thing I keep coming back to. The X402 protocol does not need to be invented. It exists. The stablecoin rates do not need to be proven. They run. The agent infrastructure does not need to be speculative. It is in production. What does not exist yet is a coordination layer, the part where publishers, data providers, AI builders, and the payment primitives actually connect into something that works at scale, that has enough liquidity, enough adoption, enough critical mass that an agent routing its queries hits the metered wall before it hits the free alternative. And this is the uncomfortable part. The coordination layer is going to be built by whoever can aggregate the supply side first. That is not necessarily the most technically sophisticated builder. It is the one with the most distribution, the fastest deals, the most aggressive pricing. In the history of payment infrastructure, there has almost never been the technically correct answer. It has been the politically connected one. Visa was not the best technology. It was the one that got the banks on board. SWIFT was not the most efficient system. It was the one that became the only system. The risk in agentic payments is not that the technology does not work. It is that the coordination layer gets captured before the open primitives have enough gravity to resist it. That the AI labs or the card networks or single dominant platform builds a closed version of the X42, calls it something proprietary, gets enough publishers signed up, that it becomes the default, and then the open standard is irrelevant because the volume went somewhere else. Every major payment network in history became dominant not because it was the best technology, because it was the first to lock in the supply side. A2S is heading for the same moment, and whoever loses that race will not get a second chance. So where does that leave you? First, the A2S model commercializes first, not A2M, not A2A. The agent pays a service model that has the clearest value proposition, the least regulatory friction, and the most desperate supply side. Publishers need this. Data providers need this. The buyers are already there. The rails are technically ready. What is missing is aggregation. Second, A2M is a political war disguised as a technical project. The authorization layer question is not going to be settled by the best architecture. It is going to be settled by whoever gets the enterprise procurement cycles first. Watch the card network. Watch what Visa and MasterCard are building quietly. They understand the threat. Third, A2A is early and will stay early for longer than anyone admits. The identity and reputation primitives for machine-to-machine commerce do not exist at production scale. Anyone telling you A2A is ready is either selling something or has no thought through the liability question. Fourth, the AI labs are wildcards that nobody is pricing correctly. If one of the frontier labs decides to ship a native payments layer as a feature of the agent runtime, the entire third-party infrastructure conversation is over. They have the agents. The payments follow the agents. Fifth, if you build anything in this space, the question is not, can I process agentic payments? It is, do I control the coordination layer or do I serve someone who does? There is no sustainable middle position. There's a version of this story where it goes well, where the open primitives win, where X42 becomes the TCP IP of agentic commerce, where no single entity owns the machine payment layer, where the internet original promise, open, permissionless, composable, actually extends into the economic layer that was always missing. Z version requires the open standard to move faster than the closed platform. In the history of the internet, that has happened exactly once. And it required a level of coordination that nobody planned, that happened almost by accident, that could not be deliberately replicated. So here's a question I cannot stop sitting with. If the agentic economy gets a payment layer and that layer is closed, and it is owned by the same few entities that already own the rails, the models, and the distribution, what exactly got disrupted? If the agentic payments layer ends up owned by the same entities that own everything else, the disruption narrative was always a story we told ourselves. If you hear for noise, scroll. If you're for deals, stay. Crypto shorts.